Good.
Good. All right, good afternoon, everyone. Thank you so much for coming and thank you for having us here today. We appreciate the ability to present and showcase our skills in front of you all today. We're presenting Poly1, as you all know. Our position is a hold position with a target valuation of $35.27. So we are from the University of Toledo. We are Team D, and our presenters today are Grant Suber, Mehul John, Neil Young, and myself, Genesis Waldron.
This slide represented the 4 targeted segments of Poly1, which are color and ink segment, performance products and solution segments, distribution segments, and specialty engineering material segments. Moving on to the investments from other slides, we have a hold recommendation for today for Poly1 on the 3 main base factors, which the first factor is the steady growth in Poly1 4 main business segments through product innovation and value-added solutions. Second, successful bolt-on acquisitions that expands Poly1 products and solution portfolio. And third is successful sustainable growth rate, cash flows that helps in successful growth rate and long-term investment returns.
And now on to the 4 segments, starting with performance products and solutions. In this segment, Poly1 creates and designs custom performance solutions to help solve complex client problems. As you can see by the graph, their operating margin has been growing steadily from 2009 to 2017. And it's also important to note in this segment, 77% of the revenue comes from the United States. Regarding the end markets for this segment, as you can see, fairly diverse end markets, with 30% of the end markets coming from building and construction. With the housing market that has been weakening in the past few quarters, we believe that that spells trouble for this segment, as that has been decreasing construction spending. And also it's important to note that sales generally come from retained customers in this end market.
So the next segment is specialty engineered materials, and with this segment it's generally composites, and what these do generally is replace heavier materials such as metals or woods. It replaces them with a more lightweight solution. So you can see over here, about 50% of the revenue comes from the United States, another quarter comes from Asia, and the last quarter comes from Europe. This segment drives heavily off of consumer sentiment. In the third quarter, you can see China's consumer sentiment was a little bit lower, and we saw that reflected in their earnings. And then the same with Europe, the Euro area. Their consumer sentiment was a little bit down in the fourth quarter, and we saw that reflected in their earnings as well. However, this segment does tend to be the most consistent from a revenue, gross product, and operating income standpoint. So just a real quick overview of what one of their target end markets is. With the rise of hybrid and electric vehicles, car manufacturers are starting to make vehicles lighter and lighter, and so they're using composites a lot for this. They replace a lot of the metal and other heavier materials, such as these on the right here, with composites, so that way they can make the whole car lighter and more efficient. With the composite portfolio, there's a bunch of different types of composites, and we won't get into them, but through those bolt-on acquisitions, they've built a really good composite portfolio, which allows them to sell all of these different ones to different clients, and they are able to provide more custom solutions. So lastly, for this segment, we have the end markets, fairly diverse, consumer, transportation, electrical, and wire is the majority. The wire and cable and electrical have a lot to do with the 5G technology that's really starting to come about, so we're going to see a lot of growth in there as well.
Going on to the color and ink segments, this segments provide specialized color concentrations for various products like plastics and ink segments, where it's performance enhancing and eco-friendly to environment. Moving on to the end markets, which are fairly diverse, and with the highest revenue generating by the packaging department of 27%. Moving on to the revenue generated by the geographical region, United States generates the most of its revenue. As you see, the operating income has a steady growth over the last 10 years by 10%, and the revenue growth is about 20% for the last year-to-year growth.
Now moving on to the distribution segment. The distribution segment usually distributes engineering and commodity grade resins, as well as other Poly1 outputs. So here we have 8 major distribution sites that are located globally. The main drivers are speed, service, delivery coverage, and environmental regulations, which highly impact how this segment operates. The distribution market is greatly correlated to the polymer resin market, and there's been a 10% increase in revenue for this segment over the last year, and it has seen 3% increase over the past 5 years. Here you have a geographical map to show the regions. You can see the United States is the major earner. Over 50% of the revenue comes from there. And the smallest market is Brazil in South America, which is under 1%. On the left, you can see the revenue and the end markets here, with transportation, healthcare, and industry being their largest end markets. This is mainly due to the nature of their customers, which are mainly loyal customers. Moving on to the company drivers, which is merger and acquisition. Mergers and acquisition is one of their major strategic tools that they use to grow this company. They have become so efficient at it that they have an actual investable playbook, which usually takes place in 3 major stages. The first stage is where they actually look at the different resources within their target company. From there, they move on to phase 2, where it is they will actually integrate everything. And then phase 3, they will look to see how they can leverage this. This has resulted in increased operating margins for the company moving forward. On the left, you can see established acquisitions where their commercial resources have increased by over 40%. And you can see this has resulted in operating margins of 900 basis points, and then it has also resulted in operating income of 150% to date. Here we have the 3 latest companies that PolyOne has actually merged with. You have Fiberline, Plasticom, and ICAP Masterbatch. These mergers have been done recently within the past 12 to 15 months thereabout, and they have contributed to great cost synergies as well as allowed for great strategic and revenue growth within all sectors of the company so far.
And building off the M&A strategy, you can see their commercial/sales team. PolyOne constantly growing through both headcount and efficiency to help uncover new customer needs and provide specialty solutions which help drive sales growth. Awesome to report that. You can see 35% more sales calls in the last year, 1,000 new customers, which helped expand their customer base by 5%. Also in the last 4 years, they've added 23% to their sales headcount, while also doubling their sales pipeline for each employee.
Great, yes, so we're just going to go over real quick the free cash flow utilization for 2018. Generally, in the past few years, they've been generating about $250 million in free cash flow. And the first thing they do with it is they utilize it for acquisitions, like we just talked about. The next is capital expenditures, so about 60 to 70% of this goes just toward maintaining their current facilities. The next, what they use it for, is dividends. So they have been growing their dividend about 10% per year per their platinum plan. And then lastly, they use it for opportunistic buybacks. So they just buy only when they feel the need to. They actually did over 60% of their buybacks just in the 4th quarter alone because everybody in the market was a little bit down and they felt it was a good time. So now moving on to our valuation today. These are our discount and growth rates. If you have any questions about these, they're in your handouts or we can answer questions at the end. But we use 3 main valuations models. So we used a free cash flow to equity. We did this at about 25% and it came to a valuation of $27.52. The next one that we used was a free cash flow to firm. This one we weighted at about 50% and it came to a valuation of $35.58. And then lastly, we used an EBITDA multiple at about 25% again, and this came to a valuation of $42.58. So our total recommendation again is $35.27. Also with those models, we did a little bit of looking at the raw material sensitivity. They had shown this in their past few earnings calls, so we decided to look at it. 2 of their main raw materials is polyethylene and butadiene. What was I saying? So we looked at the volatility of these. We put these into our distributions into a graph here shown on the right. Our recommendation is shown in the blue. So it's a little bit conservative compared to the distribution that we have, but we think that these distributions are fairly skewed due to M&A activity, so that's why we're a little bit conservative here.
Moving on to the risk analysis, some of the major risks for the polyones are divided into 2 parts, minor risk and the significant risk. Minor risk for the polyones are currency, geopolitical, and cyber attack, and the significant risk for the polygons are competition from other companies, cost of goods sold, and environmental. This is
All right,
the risk metrics.
that's the time for this. So then you can go into the Q&A side.
So this is just the last slide here, the risk matrix, and that's basically it for the presentation.
Thank you.
Let's go back to a couple of the assumption pages. Keep going.
Sure, yeah.
Let's start there for
Cool.
now.
Here?
Well, we can, yeah, I've got a question about this. So what are you doing here? Are you using peer analysis? Are you using company historicals? How are you coming up with the multiples that led to these prices?
Sure. So the only one we use a multiple for, and we use other companies for, is the EBITDA multiple. So basically what that is we look at their EBITDA currently, and then what other companies, what people are paying for other people's EBITDA multiples, and then just applying it to Poly1. So it shows, since this is below the price.
So that's a peer analysis.
Yes, correct. Yeah. And then the free cash flow to equity and firm have nothing to do with peers. They're just our assumptions of what we feel that we did like a whole pro forma on the revenue and all their expenses. And so what we feel that the cash flow to equity and firm would be.
Okay. Fast forward a slide or two, I'll tell you another one. Keep going. The one with all the sensitivities.
Oh, sorry, that's the other one.
I've not really seen that, and I'm just interested in explaining what that is.
Sure, yeah. So what we did, we looked at the historical distribution since 2009 of revenue, cost of goods sold, and operating expenses. And then obviously for each of these distributions, there's a percentage chance of the company reaching any of these. And so what we did is created a matrix that showed if any of these things happened, we would put it into our models, actually just our free cash flow firm model. Then this is what this theoretical stock price would be based on any of those given scenarios. And so the longer the bar is this way, the higher percentage chance that it would land on that specific stock price.
So I guess by that it means the blue that you're showing is using the cost of goods sold range of 0 to 2%, operating expenses. So
The blue is actually our recommendation.
oh, okay.
I put that on there to show where we were.
Have you shown us the analysis that led you to the assumptions that get you to the blue bar? You didn't show us here, but maybe you showed us here in the appendix.
We didn't. I guess we didn't put like our pro forma on there, but we put all of our discounted growth rates.
Maybe we'll start on this page too. You'll probably have questions.
Yeah, so can you talk about, obviously M&A is an important, or has been an important strategy. What about the risk to the balance sheet and the sustainability of that strategy? Do you guys have any thoughts on that?
So far, they've done a good job. I know they had one Spartech acquisition that was not great for their balance sheet. But over the past, I think that was like 7 years ago. So over the past 7 years, they've done a really good job. And we see that continuing forward. They only have a 2-person M&A team. So that is sort of a risk, and we laid that out in our paper actually. But they take a long time to find these companies. They do business with most of them already. And so they know the team, and so they're more just investing in that team rather than going out and finding somebody.
It's also important to note that for most of their M&A action, they use their cash flow because they want to keep their debt leverage relatively the same amount.
And then one interesting thing is you had that cash flow waterfall chart. Or,
Yes. Right here. Yeah. Yep.
So at first glance, I saw the buybacks. This seemed to be a very aggressive buyback schedule.
Yes.
But you mentioned that, did they opportunistically buy back in the fourth quarter based on the lower stock price?
Yes. Yeah. So they bought back about 60% of the total shares from the year just in the fourth quarter. They don't have a buyback plan. They just buy back opportunistically. They open it to as many shares as basically they could possibly want to buy back, and then only do it as they see fit. So they saw fit a lot in Q4.
Did they disclose how they financed that? How they finance those buybacks?
Not specifically. I guess we assumed that it was from cash. They didn't open up very many, if any, debt lines. They just little bit of their line of credit here.
Okay.
So,
Thanks.
yeah.
Just looking, how much did those buybacks affect fourth quarter earnings, the number? Just looking to see how that compares to the earnings number,
Yeah.
less shares.
I'm not sure how much it affected. I know it was, it's 2 million shares, and they were at 79 million, and they're about 77. I don't know exactly how much that would affect, but
What was
it
the
couldn't affect
earnings
more than a
number
few
from
cents.
Quarter 3 to quarter 4.
Sorry, say it again.
Earnings number from quarter 3 to quarter 4, do you know that? Just,
I think it was flat, and I think it was in the range of 10 to 12 cents per share. I think.
it's flat, so you could make the case that the buybacks helped the earnings number.
Sure. Yeah.
Quarter,
Yeah.
as
I would
opposed
guess
to
not
operations.
very much, maybe a few cents, but if that helps them
Yeah, I just thought of that.
beat estimates, then yeah.
You mentioned that they finance M&A through free cash because I think this is what you said, because they've kept their debt levels relatively stable.
Correct.
Is that what you said?
Correct.
I think that's what you said.
That is what I
I'm
said.
not sure, I'm sure that's true. Sure that's true.
I
They,
believe.
yeah, they keep their
Yeah.
their debt multiple, like their EBITDA or interest to EBITDA multiple. They try to keep it about 3 to 4.
Coverage ratios.
Yes.
I'm sorry, finish what you were saying.
No, yeah, that was the coverage ratios exactly. They try to keep that between about 3 and 4 times.
Are you concerned, looking in the future, about debt, interest coverage, the balance sheet in general? Can they continue the strategy that they've had with elevated debt levels that they have?
Yeah, compared to their industry, they actually don't have that high of debt levels, I don't feel. But I think they can continue. I mean, if they ever would need to, they could scale back acquisitions or buybacks if they would need to help their balance sheet. But we don't really see this as being a risk. And if they would, that'd be a significant risk. But yeah, we don't see that.
And that's 100% the right answer. I don't know if that's actually accurate.
Sure.
But I think what you said is what you said is,
Yeah.
you know what I mean?
Yeah.
I'm not sure that their balance sheet is better than their peers. You haven't really shown us. But
Sure.
but what you said was 100% true. That's,
Yeah. I know we don't have a balance sheet anywhere on here, but
So on the buybacks, the curious thing is, so certainly the corporation being opportunistic in buying back in the fourth quarter looks very, very attractive. But on the flip side, they bought 1.2 million shares when the stock was at, I'm guessing, over 40.
yeah,
Do
around
they,
now.
do they talk about that at all, or do they they're always periodically doing buybacks as a boost to earnings and the share price?
We didn't look back past a year, so I can't really say for sure. We just saw in the fourth quarter they bought a lot back, and it was mostly just due to those prices. They did a lot in November and even more in December.
Okay. I'm just curious, what was it? What was the source of that information?
It was their 10K.
Okay.
They're listed right on there.
Yeah.
Yep.
You got about a minute and a half.
I know we didn't answer everything.
maybe
So with the Monte Carlo sensitivity, does it show that there's any correlation between the three inputs? Or is it just say, in any given instance, revenue could be down 13% and then, is there a correlation between those three variables?
Yeah, a little, but not. I tried to take as much out as I could. So the cost of goods sold is actually increase or decrease in a percentage of the cost of goods sold relative. So how do I explain this? The cost of goods sold margin. It's the increase or decrease in a cost of goods sold margin. Does that make sense?
Yeah, so it's contextualized at least. I think what you're saying is there's some linkage between the revenue variable and the cost of goods sold variable that's utilized in this sensitivity analysis.
No, I tried to take that out.
Okay,
So
okay.
what I did was, cost of goods sold, it's at about 78%. So I looked at, for all the quarters back to 2009, what was the percentage, and then what did that change quarter over quarter?
Okay,
Does that make sense?
yeah, okay, thank you.
Yep.
That's the time.
Okay.
Thanks, guys.
Thank you.
Thank you.
Thank you.